This is Kyle, real estate editor here at Sundae. I'm sitting down today with the lead economist, Polina, to talk about what's going on in the market. So the first question I have for you, Polina, is, are we heading towards a recession?
Well, that's a great question. By some accounts, we are already in a recession. It really depends who you ask. It's definitely a question on everybody's mind because we do see Google searches go up for a recession. Technically, an official definition from the National Bureau of Economic Research is that recession involves a significant decline in economic activity, which is spread across an economy and lasts for more than a few months. And we have seen a negative GDP number in the first quarter. It looks like we will have another negative number for Q2, but we don't know that for sure yet.
Okay, and so when we're talking about this definition of a recession, we're looking at three different things, right? Depth, diffusion, and duration. Would you mind explaining that a little bit to the audience?
Yes. So it means that the negative impact has to be felt by the economy broadly. It has to be felt by more than one industry and not just by one sector of the industry. That's what the depth is. And then the diffusion is that it has to be felt by more than one state. So, for example, when you think about hurricane impact, right, it usually impacts one or two states. And then the duration, it should be for at least a couple of quarters. An exception to this was COVID, because during COVID, National Bureau of Economic Research decided that it actually qualifies as a recession because it was severe and it was so widely diffused throughout the economy and it impacted every single state.
Absolutely. Yeah, that makes sense. Now, given the criteria we just stated, how are we doing in relation to these? Because I know you said that there might be negative GDP for a second quarter in a row. How are we doing on the other measures that we should be looking at and other indicators?
Well, if we look at this by state, we do have one of the feds. It's the Federal Bank of Philadelphia. They publish their monthly state coincident indices. And so what you would typically see prior to a recession is that at least 5 states will start posting a declining activity for at least 6 to 7 months. And we aren't seeing that quite yet. And over the past 3 months, all of the indices in all 50 states have been increasing.
Okay, so that's really reassuring. But why do we keep hearing things about, layoffs, and we hear, inflation, and all of these other factors? So it's not adding up for a lot of people where we're not seeing the numbers for a recession, but yet there's a lot of talks about it. There's a lot of people getting nervous about it. So what can we do to explain that to the people who are seeing or giving multiple types of information?
So when you think about layoffs, you have to put this in context, because what happened during COVID is that companies staffed to keep up with demand caused by COVID. So when you think about companies like Amazon, for example, people were sitting at home and they were buying up goods to improve their housing conditions. They were cooking at home more. They were entertaining themselves at home more. They were buying Peloton bikes. They were having a lot of things delivered. So Amazon had to expand their warehouses. They had to hire more people to distribute, to transport. And what you see now are a lot of layoffs from companies that had to hire people to keep up with that demand. We see layoffs in the mortgage industry. A lot of a lot of mortgage companies had to staff up to keep up with the volume of refinances, right? Because the interest rates were so low and people were refinancing. So if you think about Netflix, they stopped adding as many users every month once the economy opened up and people were able to go out and go to the movies again or entertain themselves in other ways. So companies like Robinhood is another example of that. It was a pandemic side effect when too many users opened up too many accounts. So when you're stuck at home with a little extra money and nothing to do, you start, watching a lot of TV or trading meme stocks or exercising and buying up equipment. And so what we're seeing now is a side effect of that.
Would you say we're reverting back to sort of like a mean, so to speak, then, where we were maybe overextended before and now we're just kind of coming back to what things like should be? Or how would you further explain that?
Definitely, that's what it seems like, because companies were ordering inventories, assuming that the demand will continue to be the same as when people were staying home. And it changed.
And how does interest rate play into all of this, Polina?
So interest rates primarily impact the housing industry, right? Because it makes your monthly payment a lot more expensive. So interest rates slow down the housing demand. They make homes less affordable for people. So if you think about what happened during COVID, interest rates going down, a lot of people who couldn't afford to buy a home all of a sudden were able to afford to buy a home. And they used that as an opportunity. So that was the reason why we saw so many bids. Technically, if you think about this, housing became deflationary during that period because you could not just because you could qualify, but because if the mortgage payment was, for example, $2,000 at 6% mortgage rate, it would have been $1,200 at 3% mortgage rate.
Yeah, so things were way more affordable on a month-to-month basis when the interest rates were lower. But now that they're jumping up, people are looking at that and saying housing might not necessarily be as affordable for some, anyways, who look at it on a month-to-month basis. So, what are we seeing as reactions for that, or is there still enough demand to deal with the supply?
Well, the inventory levels compared to pre-COVID time are still very low. And I can't speak for the entire United States, but in most markets, they're still below that level. They're still not, if you compare it to last year, the inventories are definitely up. And that's usually one of the driving factors, right? If you don't have enough supply, then people will fight for whatever is out there. And housing is basic shelter. It's one of the things you need to live. So for now, we're still seeing housing prices go up despite the slowdown in demand. And we definitely see the slowdown in demand because you do see an increase in days on market, and you do see a drop off in the purchase activity in the mortgage purchase applications. But the overall prices are still going up. You still see multiple bids. You still see the average sale to listing ratio above 100 in some markets, in some hot markets that are supply constrained. For example, in Oakland and San Jose, it's around 110, which is very high.
Wow. Okay, so Polina, it's very interesting because I feel like it's very much mixed signals right now in the market, where on one hand, we've got very high inflation, the highest in something like 40 years. it looks like the stock market is in a bear market, but at the same time, we're seeing that real estate is still doing really well. So I guess my final question is, if we're not in a recession yet, is there going to be one?
It's like I said, some people think we already are, right? Because it's not, you can't just go by one definition. It's sort of a model where you look at different indicators. It's a progressive model. We're not seeing this reflected in employment numbers. In fact, what's interesting is while you see the Google searches for recession go up, you see searches for unemployment benefits go down. What's phenomenal is leading up to the 2008 recession, we saw both searches for recession and searches for unemployment benefits go up and go up together. There was almost a perfect correlation in how they went up. So even if we do see a recession by the National Bureau of Economic Research definition, where we see negative GDP growth, because we have so many job openings, and again, to put that in context, we have 11 million versus, I believe we had either 2 or 4 million back in 2008, but it was a very low number. We should be able to weather the storm, and it should be relatively mild. And again, because of the nature of this, I don't see this impacting housing that much. In fact, one of the things that you see happening now, the Fed is slowing down the demand by increasing the interest rate. It also impacts the supply of housing because builders also need capital in order to build, and capital for them is becoming more expensive.
So even in this environment, how can people investing in real estate find the best outcome? Like how can somebody win even with this these higher interest rates? What strategies or tactics would you recommend?
So I think that landlords will definitely benefit because rents will continue to go up. One of the things you see now is vacancy rates continue to decline and prices continue to go up, which is not something you see often. Right now, it's difficult for the fix and flip investors, especially those that can finance with cash, that can buy with cash. Just because the capital partners are figuring this out as Fed continues to raise interest rates aggressively. That said, this should stabilize soon. You can see that rates aren't holding up. Mortgage rates are based on the 10-year yields. They're priced off of the 10-year yields. And if you look at the 10-year yield performance, you see that it spiked around 3.5, but it wasn't able to stay there. So it's also kind of an indicator that the economy is just not strong enough. We don't see very strong yields. And another thing, if we do officially enter the recession, the mortgage rates have to come down. Historically, if the Fed sees unemployment rate inching up, they will slow down. It's a very difficult balancing act on their part. There are some positives that we're seeing right now. You definitely see that financial conditions have tightened significantly, and they tightened without the Fed doing much. So maybe they won't have to do much. So right now it's a tough time, kind of, if you remember what happened right after COVID, when the market just froze because nobody knew what to do. we're experiencing that a little bit, but there's going to be more clarity. And inflationary pressures are easing.
Absolutely. And one thing we have to give the current Fed Chairman Jerome Powell is he's known as Pivot Powell. So just because he did one thing the last time there was a rate hike doesn't mean that that is going to necessarily affect future hikes. If he sees things that might change his mind and we see conditions change without him having to adjust rates. Would you agree with that?
For sure. And I think, I guess he says a lot of things. One of my favorite quotes from last week is he said, I think we now understand better how little we understand about inflation, which is great. But what I do appreciate about him is that he does adjust his strategy based on economic factors. Even if the Fed appears to be slow to adjust, you have to understand that in the context of things happening, it's always hard to act immediately. It's much easier to say, oh, they were wrong in hindsight. But it's tough when you have a lot of economic indicators that you need to use to make your decision in real time. And there's so many things that you can blame inflation on, like COVID and Congress and, the CARES Act under Trump, under Biden, and, consumers overspending and the Russian invasion of Ukraine. You pick your poison, whatever you want it to be. Some people even blame it on the tax cuts of 2017 and then the infrastructure of 2022. It's messy, and I think that everybody is doing the best they can, and it's hard to figure things out when so much is going on. That said, we need to stick to what we know when so much is happening, and what we do know, there is a supply shortage of housing. It's basic shelter. A lot of people need it. And we do see investors being successful. And we know that vacancy rates are very low and the prices are still trending up, and the markets are weathering the storm.
Absolutely. Well, thank you so much for joining me today, Polina. I certainly learned a lot and hope the listeners will too.
You're welcome. Great to be here.